Broadcom stock, ticker symbol AVGO. Is this the best dividend growth stock to buy right now? The market is very volatile, and so is this stock. It's down 16.9% year to date, which is quite interesting since the overall market is down 20%. Broadcom is loved among the investors because of the growth potential. But another great thing about Broadcom is the fact that they are a great dividend stock. Dividend yield of 3.3% and growth rate is at 32%, which is really high. Broadcom just released earnings on the 8th of December, where they beat both on EPS and revenue. But does this also mean that Broadcom stock is a buy at current prices? Well, in this video I'm going to show you real quickly what Broadcom does. The most recent earnings, the historical returns, the fundamental analysis, dividends, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does AVGO do? Broadcom AVGO boosts a highly diverse product portfolio across an array of end markets. AVGO focuses primarily on radio frequency filters and amplifiers used in high-end smartphones, such as Apple iPhone and Samsung Galaxy devices. In addition to an assortment of solutions for wired infrastructure, enterprise storage and industrial end markets. Legacy Broadcom target networking semiconductors. If we dive in the most recent earnings report, we see that net revenue is up 21% year over year. Net income is up 68% year over year, which is insane. So profit margin is increasing quite a lot there. Earnings per share is up 75% year over year, which is also very nice. Free cash flow is up almost 30%, so this comforts me a lot. AVGO is capable of growing in high amounts. The net revenue by segment is also quite interesting. Semiconductors is representing 79% of the total revenue and is up 26% year over year, while infrastructure is representing 21% and is up only 4% year over year. So the biggest segment is growing in high amounts, which is quite interesting to see. And one of the things I really like is the fact that gross margin is growing in the past couple of years. And of course other statistics as well, which we will cover later in this video. The last thing that I want to mention is that Broadcom increased dividends by 12% to $4.6 and first quarter revenue guidance of approximately 8.9 billion and an increase of 16% from the prior year period. And now that we know more about this company, it's time to check the fundamentals of this stock to see if it's a buy at current prices. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe and in return you receive similar analysis to this one every week. Let's continue by diving into the fundamentals. AVGO is a 227 billion market cap company with a PE ratio of 18, which could indicate that they are undervalued. Later in this video I will show you my 3 price targets for AVGO, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 34 billion and in this graph we see that revenue went up really nice and steady, so this comforts me a lot. Net income is at 12.38 billion, which gives us a profit margin of 36%. The thing that I really like here is the fact that the current profit margin is significantly higher than the 5-year average of 23.9%. And this is also something that we saw in the earnings report. Margins are increasing, so this looks very good to me. EPS is going up and down quite a lot, but ever since 2020 it went straight up. So this is something to keep your eye on in the future. Price to sales ratio is at 7.19, which is way too high in my opinion. I prefer this number below 2 for this type of company. Another thing that I really don't like here is the fact that it's increasing over a longer period of time. And it's the same story with the price to book ratio, which is sitting above 10, way too high in my opinion. Price to free cash flow is sitting at 15.6, which is very interesting since I prefer companies with 20 or lower. And tech companies usually have a way higher number here, so this is something that I really like of course. Analysis expect mid-single digit growth numbers in EPS for the coming years. For the revenue, they expect low single to mid-single growth numbers, which is kinda disappointing to me. Return on assets is sitting at 17.6%, which is above my 10% minimum, so this looks very good, and it's the same story with the return on equity. But the most important number here, return on invested capital, is sitting at 19.8%, which is really nice since it's above the 5-year average and also above the 10% minimum. Current ratio is at 2.6, which is too high in my opinion. I prefer 2 or lower. It's also increasing in the past couple of years, so definitely keep an eye on this number. Total debt is at 39.5 billion. I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now, total cash is sitting at 12.5, so they are almost capable of paying down a third of the total debt. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in this graph we see that free cash flow is going up really nice and steady, so this comforts me a lot. Another thing that is interesting are the shares outstanding. It has increased quite a lot in the past decade. However, in the past couple of years it's nearly flat. And to me it's very important that shares outstanding are decreasing, since it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyway, dividend yield is sitting at 3.3%, which is really high for a tech company. Annual payout is at $18.4 a share and payout ratio is sitting at 44.9%. I prefer companies who have a payout ratio lower than 50%, so this looks all good to me. The 5-year growth rate is at 32%, which is one of the main reasons why people love Broadcom stock. They grew the dividends for 10 years in a row, so that's also pretty impressive. Overall, a great looking scorecard, but does this also mean that AVGO is a buy? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 5, 7 and 9%, since I think they will increase the revenue quite steady, but not at the same pace as they do right now. Profit margin I'm filling in 30, 34 and 38%. And for the free cash flow margin I'm filling in 40, 42 and 44%. For the PE ratio and the price to free cash flow I'm filling in 17, 18 and 19. My desired annual return is 12.5% since I can get an easy 10% average annual return owning an ETF. Right now AVGO is at $552 a share. I hit analyze and we do see a few green numbers. We have a low price target of $372 to $496, which is quite a big drop. We have a mid price target of $505 to $624, and we have a high price target of $678 to $785. To me, the mid price target is the most justified here, so that's still quite a big range to be honest. My final conclusion is that I really like this company, and most of its fundamentals as well. Dividends are looking great and they are growing the revenue, net income and free cash flow at a pretty high pace. But the valuation is a bit tricky. I don't think they are massively undervalued or overvalued, and to me it feels like the stock should come down a little bit more before buying. Right now I don't own this stock, but I have it on my buy list for around $500. That means a 10% decrease in stock price. Which sounds like a lot, but we are in volatile times right now, where this could happen very easily. So for now I'm waiting for the stock to come down to around $500. And as soon as it hit this number, I'm analyzing the company again. And there is a chance I'm buying this dividend growth stock big time. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.